Welcome to Property Tax 101, a tutorial on property tax policy and how property tax rates and property taxes are calculated. We're fortunate to have Doug Stein, consultant with the Government Finance Officers of BC and the now retired manager of revenue services for the Corporation of the District of Saanich here with us. Thank you, Doug, and over to you.
Thank you, Gabby. On behalf of the Government Finance Officers Association of BC, I would like to welcome you to the Property Tax 101 tutorial. The Government Finance Officers Association of British Columbia, or GFOA BC, represents local government finance officers in BC, such as the Director of Finance, the Chief Financial Officer, or the Manager of Financial Services. GFOA BC has over 1,000 members representing 160 municipalities and 28 regional districts in the province. GFOA is focused on the support, education, and development of finance professionals. And besides the annual conference and the Finance Officers Boot Camp, GFOA offers a wide variety of courses, webinars, and workshops on topics of current interest and relevance to municipal finance officers. The purpose of this tutorial is to provide an overview of how the services that are provided by local government are financed, the legislation relating to property taxation, the factors to consider in determining tax policy, and how property tax rates and property taxes are calculated. Now, it certainly would be nice if money grew on trees, but we know it doesn't. So how does local government finance their services? Well, we have a variety of sources, as we see on the screen: property taxation, local area service taxes, and parcel taxes. We have the provision of fees and user charges, grants, payments in lieu of taxes from the federal government, the 1% utility tax. Of course, we can borrow money, and we do receive money from development revenue like DCCs. The authority for municipalities to levy property taxes and other fees and charges is found in the Community Charter, as we see listed here in section 192, which says that the municipalities have the following revenue services, and that is fees, property value taxes, parcel taxes, local service taxes, taxation of a utility property, that's the 1% utility tax, and fines and other penalties due to the municipality. Now, section 193 of the Charter also states that a municipality may not impose fees or taxes except as expressly authorized under this or another act, and that a council may only provide an exemption from property taxes if expressly authorized by this part or another act. So we see then that the Charter gives local government the authority to raise specific types of revenue, such as property taxes and fees and charges. An example of a source of revenue that is not listed in the legislation is sales tax. So here are some examples of how local governments finance their municipal services, such as protective services, police and fire, parks, road maintenance, street lighting. Now, some services are funded by a parcel tax, and capital projects may be funded by grants or borrowing. Now, as we look at the list, we see that municipal services are primarily funded by property taxes. However, notice recreation services. This is an example of a service being financed both by a user fee and property taxes. Also notice refuse collection as an example. This is an example of financing a service with a utility charge, or outsourcing this service, or even private contracting. As we can see in this chart, property taxation accounts for the major share of municipal revenue, like 50%. In British Columbia, we have an efficient property tax system. It is relatively easy to administer, easy to distribute the tax burden, it stabilizes property values, and it encourages investment. The legislative authority to administer property taxes is found in the Community Charter and also the Local Government Act. For example, the legislation requires that a municipality must have a financial plan that is adopted annually by bylaw before the annual property tax bylaw is adopted. Now, with regards to the annual property tax bylaw, Section 197 of the Charter states that each year after the adoption of the financial plan, but before May the 15th, a council must by bylaw impose property value taxes for the year by establishing property tax rates. Now, the purpose of Section 165 is to further enhance accountability to the public, to assist municipalities in making more considered and meaningful decisions regarding their revenue and tax policies, and to encourage public participation into the financial decision-making process when preparing the financial plan. Section 165 of the Charter also states that the financial plan must set out the proposed funding sources. And so we're going to consider specifically property taxation. And as a side point, Section 166 of the Charter requires that a council undertake a process of public consultation regarding the proposed financial plan before it is adopted. And as we said, the financial plan must be adopted before the tax rates bylaw, and the tax rates bylaw must be adopted before May the 15th of each year. So what is property tax? Well, it's a tax on real property. It's an ad valorem tax, which means in Latin, based on assessed value. And it's a BC Assessment Authority who determines the assessed value. And it's a tax rate applied to those values. Now, by definition, a tax is an amount that is authorized by legislation, primarily the Community Charter and the Local Government Act, and there are a few more. It is compulsory. That is, the taxpayer has no choice but to pay the tax. It is levied by a public body, such as a municipality, regional district, maybe the Municipal Finance Authority, maybe British Columbia Assessment Authority. The monies raised by property taxes are intended for a public purpose, as opposed to a specific purpose or service. And where there is no connection between the amount of taxes raised and the actual cost of the service provided to the payer. So a tax differs from a municipal fee or charge in which there is a connection between the amount charged for a service and the cost of providing that service. Where there is no connection between those 2 points, it is a tax. We want to keep in mind then that a property tax is indeed a tax on real property, that is, land and improvements, such as a house. So municipalities do not tax people. Municipalities tax properties. And a property tax is not based on income, for example, income tax. Property tax is not a tax for services, or it is a tax available for services to all in the community, such as fire and police services and parks, whether or not those services are ever used. It's still a tax for those services available. And since property tax is based on the value of a property, it is considered a wealth tax. And a taxpayer's property is a proxy for their wealth. Now, in setting tax policy, there are several principles to take into consideration. It should strive to be neutral so that decisions are made on their economic merits and not for tax reasons. It should be equitable, cover the cost of services that provide collective benefits to the community. Property assessments are based on market value, so that the same tax rate applies to all properties in the same class. It should be predictable. It should be a stable revenue source to local governments and also predictable for the taxpayer. It should be flexible due to changing circumstances. It should be transparent and visible. It should be easy to understand and to administer. Now, our property tax system in British Columbia basically reflects these principles very well. So as we mentioned earlier, the legislation requires that a municipality have a financial plan. The financial plan sets out the objectives and policies relating to the proportion of the total revenue that is proposed to come from each funding source, such as property taxes. The distribution of property taxes among the property classes that may be subject to the tax, and the use of permissive tax exemptions. So the first requirement of the financial plan is that for each of the funding sources described in subsection 7 of this section of the charter, the proportion of total revenue that is proposed to come from that funding source. So this is actually the last step when preparing the annual budget, this first requirement of the financial plan. And subsection 7 then lists the proposed funding sources, which was mentioned earlier, that is property taxes, parcel taxes, fees and charges, or revenue from other sources, and borrowing. Now, with regards to tax policy, I would like to skip to the third requirement of the financial plan, and that is the use of permissive tax exemptions. And so we see in the slide 2 examples of a property that would be exempt from taxation: a building set apart for public worship and a community hall. Now, every property in British Columbia must be assessed by the BC Assessment Authority. And the owner of that property must pay property taxes unless the property is specifically exempted by the legislation. So the charter in section 220 states that certain properties are exempt from property taxes. For example, federal properties, provincial properties, properties owned by other municipalities maybe. And then in section 224 to 226, it allows local governments to also exempt certain other types of property, such as the land surrounding a building set apart for public worship, the parking lot, or property owned and used by a charitable organization. So council has the discretion to exempt those certain types of properties from property taxation. Other examples of permissive tax exemptions are properties that are designated as heritage and properties designated for revitalization. Now, in order to exempt a property from property taxation, council must pass a permissive tax exemption bylaw by October 31st of each year to be applicable in the following year. So here are some of the factors that may be considered in determining whether a property should be exempted from property taxation. What do they do? What is the owner of the property, the organization, doing for the community? How long do they want the exemption for? Is there a financial need? One of the most important ones is, does the use of the property meet the objectives of council? Not just the objectives of the organization, but of the municipality. Also, the organization should provide some form or type of community benefit. And what is the organization's primary revenue source? And is it receiving other funding or benefit from the municipality? Now, it must be kept in mind, though, that Section 25 of the Charter states that a council must not provide a grant, benefit, advantage, or other form of assistance to a business, including an exemption from a tax or fee. So then this brings us to the second requirement of the financial plan: the distribution of property value taxes amongst the property classes that may be subject to the taxes, like cutting up a piece of pie. In other words, how much of the property taxation should each class of properties bear or pay? This distribution of property tax burden is accomplished by what is called the variable tax rate system. So here's where property assessments and property taxation merge. We have class 1 properties, residential, class 2 utilities, class 4 major industry like a pulp mill, class 5 light industry like a manufacturing plant. Class 7 is managed forest land. Class 8 is a recreational property. Class 9 is a farm property. Now, if a property does not fall into one of those 8 categories, then it falls in by default to class 6, which is business and other. In other words, most commercial properties in British Columbia fall into class 6, and that can go anywhere from a huge retail store down to the corner store. Now, calculating tax rates would be simple if there was just one class or type of property. Then one rate would apply to all properties. I mean, this would be called a uniform tax rate. However, we have 9 property classes or types. Now, it should be noted that not all municipalities will have properties in all of those classes. Now, the charter in section 197 states that the property tax bylaw may establish a single rate for each property class. So each class of property then may have a different tax rate. So therefore, there could be 9 different tax rates if so desired. This is up to council. And this system enables municipality to distribute the burden of taxation among the different types of taxpayers. This table illustrates the variable tax rates. We have the classes 1, 2, 3, 4, 5. We have their description. So class 1 is a residential property. Class 2 is a utilities property. Class 9 would be farmland. And BC Assessment Authority determines which class a particular property fits into. And the majority of properties in British Columbia are residential properties. And we see then in the next column the rates that have been applied for illustration purposes to each class. For example, class 1 residential, the tax rate is 3.2432. So if we, as an example, take this residential property that is assessed, say, at $500,000 and a tax rate that is 3.2432, well, then we have what the property taxes would be for that property. That is $1,621.60. Now, the relationship between the tax rates of different property classes is called the ratio, which is what we see in the far right column. And that is class 1 ratio, well, class 2, 3, 4, 5, 6 rates are a relative to class 1 rate is a ratio. And that's all it is. It's just mathematics, 2 numbers relative to one another. It's a ratio. In other words, we see class 5 and 6 there. Their property tax rates are almost 4 times more than the class 1 residential property. Now, does this mean that a class 6 property will pay 4 times more than a class 1 property? Not necessarily, because each property has a different assessed value. It's also important to note that if we change the rate, that would change the ratio. And if we change the ratio, that would change the rate. And that could get very complicated. Now, this slide shows some of the factors to consider in formulating a tax policy, which would then determine those rates. Council may want to maintain the current tax burden per class. They may want to limit the tax increase to a certain percentage overall or for a specific class, such as limiting the tax increase just to residential properties. Or they may want to reduce the commercial tax burden. Doing this would shift the tax burden from commercial property class to the residential class, and that would have significant ramification. But council may choose to do that or do it over a period of years of phasing in such a change in tax rates. Another consideration in determining tax policy is how council wishes to use any additional revenue due to new construction. And that is, new construction tax revenue could be used for reducing the current year general tax increase, or it could be used for a specific purpose or project, or it could be put aside in a reserve fund for future use, or any combination of the above. Now, other factors that council might take into consideration might be the community's desire for services and facilities, the financial requirements of the municipality, past taxation practices, and the need for stability and predictability. The next step is to distribute the tax burden among taxpayers, or in other words, how much of the tax burden should each class bear? Council may distribute the burden as a prorated percentage among the classes, or council may distribute the burden as a fixed dollar amount among the classes. Now, some municipalities use the tax ratio approach, and this approach refers back to the relationship of the property classes to the residential class. For example, if business class rate is 4 times the residential tax rate, then that same ratio would continue to apply. As we saw earlier, this means that the tax rates would have to be adjusted accordingly. And some municipalities use a revenue neutral approach, which adjusts the tax rates in order to collect the same dollars for all the classes. And if there would be a tax increase, that would be allocated across all property classes equally. Now let's take a look at the actual process to calculate taxes. Now the following is a very simplified explanation. GFOA offers a one-day workshop for financial officers on tax policy and calculating tax rates. I'm going to try to do it in one slide. So step 1 is to determine the tax revenue that will be required. And that means subtracting all other sources of revenue from the total expenditure. And that comes to the amount of taxes that would be required to balance the budget. That amount of money is then divided by the total assessed values of each property class to arrive at the new tax rates for each property class. Now, one takeaway from this is that it doesn't matter what the assessed values are, the assessment base. Doesn't matter, because a specific amount of revenue needs to be raised to pay for the services provided by the municipality. And then it basically works backwards. We need this amount of money, and we have values, and then we determine the rates. Now, the second step in the process is to input those tax rates to determine the new distribution and the ratios amongst the classes. And again, the legislation kicks in here. Class 2 utilities property and Class 4 ports property have legislated capping that they cannot exceed. And then the third step is to now adjust those tax rates according to your tax policy. Or you may want to run a couple of what-if scenarios to see how that would affect the overall burden of taxation among the classes. And again, adjusting the tax rate will affect the amount of taxes and also the tax rate ratio among the property classes. So let's briefly review the takeaways. Tax rate calculations can be affected by many factors, which include assessed values, the approval of permissive tax exemptions, legislated rate caps, and council policies. Now, although grouped into property classes, each individual property within their class is indeed unique. The next step that council has is to pass the required bylaws, the financial plan bylaw, and then the property tax rates bylaw. And this needs to be done before May the 15th of each year. Then as a final step in the process, the property taxes are calculated for each property and tax notices are sent to each property owner. Now, sometimes when a taxpayer receives their tax notice, they may wonder, why did my taxes go up? Well, to answer that question and to summarize how assessments and property tax policy affects property taxes, I invite you to watch the following short video.
Meet the Johnsons. Last year, Michael and Ellie bought their first home and have now received a property tax notice. Although they're somewhat familiar with property taxes, they have some questions. How is my tax money spent? Around half of property taxes are used by the city to pay for public services, such as our police and fire departments, our libraries, road repairs, streetlights, parks, pools, and more. The other half goes to provincial agencies in the regional district, such as Metro Vancouver, TransLink, BC Assessment, Municipal Finance Authority, and the Ministry of Finance to fund schools. Who sets the tax rate and what is it based on? First, the annual budget and the 5-year financial plan is approved by the City Council, which determines the level of service provided to residents each year. Once all of the expenses are established, other estimated city revenues are subtracted from this amount until we arrive at the property taxes that are needed to balance the budget. In short, our city's budget requirements, minus our city's revenue, equals the total property taxes needed for the year. How do you calculate our portion of the property taxes? Property taxes are based on the assessment value provided by BC Assessment, and by law, the city cannot collect more taxes than what is needed to balance the budget. City staff must recalculate the tax rate for each type of property every year to make sure we only collect what is needed from all property owners. How do we do this? Let's assume an imaginary town has 3 properties, and all 3 properties have the same assessment value of $100,000. Assuming the total taxes needed to balance the town's budget is $900, then the tax rate must be set at $900 divided by the total value of all properties, which equals $0.003, in order to collect the $900 needed for the town to operate for the year. That means each property would have to pay $100,000 times $0.003, or $300. Each property pays their share of taxes based on their assessment value. This looks simple, but what happens if the assessment values change? Okay, let's assume the following year the assessment looks like this. House number 1 is assessed at $150,000, house number 2 at $100,000, and house number 3 at $70,000. House number 1's assessed value increased by 50%. House number 2's stayed the same, while house number 3's decreased by 30%. In this scenario, the average new assessment value increased by $6,667, or 6.67%. If the total taxes needed to balance the town's budget are the same in year 2 at $900, then a new tax rate must be calculated in order to balance the budget. $900 divided by the total value of all properties, which equals $0.0028125. That means the taxes that each house pays in year 2 will change to $421.88 for house number 1, $281.25 for house number 2, and $196.87 for house number 3. The town still collects the $900 needed to operate for the year, but compared to year 1, each house will pay a difference of plus $121.88 for house number 1, minus $18.75 for house number 2, and minus $103.13 for house number 3. In our example, the average assessment value increased by 6.67% in year 2. Because house number 2 and house number 3's assessment value change was less than the average, they had a tax decrease, even though the city didn't collect more in total taxes. Only house number 1 with the 50% increase in assessment value had to pay a significant increase in taxes. This is a simplified explanation of how your taxes are calculated each year. But all in all, your city council works hard to ensure that you get the right level of services, and your tax department works hard to ensure that your property taxes are billed correctly. Review the assessment notice sent to you in January of each year by BC Assessment to make sure the assessment value of your property is correct. If you disagree with the assessed value, you have until the end of January to appeal the value with BC Assessment. If you have any questions or concerns with your assessment, please contact your BC Assessment office for clarification.
So now we know how to calculate tax rates. I hope that this discussion has provided a better understanding of property taxation and calculating tax rates. On behalf of the Government Finance Officers Association of British Columbia, I want to thank you for watching this tutorial. And if you'd like further information, please feel free to contact the Government Finance Officers Association of British Columbia or myself. Thank you.